Hello and welcome to the IFS Zooms In. I'm Helen Miller, Director of the Institute for Fiscal Studies. In the last episode, we talked about the budget and the big picture choices that the Chancellor made. Today, we are talking about the budget again, and this time picking up on some of the smaller but no less interesting or important policy measures, tax policy measures that the Chancellor made. So if you want the big picture or the story about frozen thresholds, go back to last week. But for today, we're going to dig into the detail on the many other tax policy issues. We'll talk about how the government's going to tax cars and some actually rather counterintuitive effects that's going to have, about how the government wants to tax various types of savings, energy, tourist taxes, and much more besides. And to do that, I'm once again joined by Stuart Adam and Ben Zaranko, both of my colleagues here at IFS. Regular listeners will recognise that Ben and Stuart joined me for the How Do You Fix the Tax System series. So Stuart is our in-house encyclopedia on all things tax design, and Ben is here to keep us out of the weeds. Let's let the fun begin, shall we? Stuart, we are going to start today talking about cars, because I think it's the bit that you've got excited about in general and for this budget in particular. So before we get into...
I think we should clarify that you mean the tax of cars, because Stuart's not just become like a motorhead overnight.
Yeah. Like there's no Top Gear stuff here. This is the taxation of electric vehicles in particular. So kick us off first with what are the changes to the taxation of electric vehicles? Then we'll dig into the funky effects they're having.
Yeah. So the big change that was announced was the introduction of a 3p per mile charge on driving electric cars from 2028. There were also actually 5 or 6 other measures announced, which all, in one way or another, aim to make electric cars more attractive. And that's things within vehicle excise duty. There's an electric car grant for buying certain kinds of electric cars. There are changes to capital allowances for businesses buying electric cars. There's more funding for charging infrastructure. Changes to benefit-in-kind rules, and I think one more I'm probably forgetting. But there was a whole bunch of smaller measures to make electric cars more attractive, as well as the per mile tax that obviously makes electric cars less appealing.
I think that will be counterintuitive to many people. The idea that on the one hand you're making them less attractive, on the other hand you're making them more attractive. But there's a good reason that you're going to walk us through as to why. There is a good reason to get people to buy electric vehicles in the first place, but then tax them once they're driving them.
On the one hand, there is a good argument for saying in the long run, we do want to be taxing people for driving electric cars. Driving electric cars causes harms to wider society, particularly in the form of congestion and also other kinds of like local air pollution and things that you still get to some extent with electric cars, even if there aren't carbon dioxide emissions. And, accidents on the road, things like that. So there are good reasons to want to tax electric cars, although ideally, as I think you discussed in the last podcast, there will be a big tax on driving electric cars in congested times and places and not other times and places. But nevertheless, there's a good argument for taxing driving them. But in the short run, we want to encourage people to take up electric cars, and we want to get people to switch from petrol and diesel to electric cars, and that we need to do that if we're going to meet our net zero target for 2050.
So we might come back to the congestion point, because interestingly, actually, the government's saying this is all about wear and tear, but congestion is the big cost, not the wear and tear. But there's an exciting interaction that we should tell people about, because it's a cracking bit of economics, about how all of this interacts with the EV mandate. And in fact, as I say this, I'm realising we should have made this the question for the intake of research economists into IFS this year, because it's a very classic kind of question that we might give to our new juniors. But tell us what the mandate is and tell us about this funky interaction.
Yeah, so precisely because the government wants us all to be moving over from petrol and diesel cars to electric cars, it has set out in law that essentially a certain proportion of new cars sold each year have to be electric. And that proportion rises year on year until we reach the point where all cars sold have to be electric. That essentially completely changes the way that you'd want to think about the effect of taxes on different kinds of cars, because essentially the proportion of new cars sold that's going to be electric is now set down in law. And so either taxing them more or subsidising them more can't actually mean that a higher proportion or a lower proportion of cars sold is going to be electric, because essentially the mandate just dictates that. And so when, for example, the government introduces this 3p per mile tax on driving electric cars, if that means that fewer people want to buy an electric car as a result of that, that means the manufacturers can't sell them fewer electric cars unless they also sell fewer petrol and diesel cars. And so what will happen is that they'll reduce the price of their electric cars and increase the price of petrol and diesel cars until that percentage is what the mandate says. And so it may lead to fewer cars overall being sold, but it can't lead to fewer electric cars relative to petrol and diesel cars. And that's exactly the same, but in reverse, for all of the other policies that make buying electric cars more attractive. It's just got to change the relative prices of electric cars versus petrol and diesel cars to undo that. And so, weirdly, having an electric car grant, a grant for buying electric cars, actually has essentially the same effect that a grant for buying petrol and diesel cars would do. It makes all the cars less expensive, but it can't make electric cars more or less attractive relative to petrol and diesel cars, because the mandate just sets out what proportion of each must be sold, and the prices just have to adjust until that's the case.
How are we doing, Ben? Ben's frowning.
I'm going to have to break this one down a little bit. So if it wasn't tricky, we wouldn't think about using it as an interview question. Right, so can I ask about this mandate first? Presumably it's not set as a precise... Is it that you have to sell this percentage of electric cars and this percentage of non-electric cars, or is it like a floor? I mean, would the government be upset if we were running ahead of our electric vehicle targets and to tell the companies to go back to... You're actually accidentally selling 19% rather than 18%. Go back to 18%.
So I don't think there's much danger of overachieving the target. It is more complicated than a simple percentage. So for one thing, the mandate applies to each manufacturer, but different manufacturers can trade allowances with each other. So one can sell more than the specified percentage if another one sells less than the specified percentage. There's also so-called banking, so you can do more in one year if you're going to do fewer in future years. And you can actually sell more petrol and diesel cars if you make the petrol and diesel cars less dirty than they used to be. That kind of allows you to relax the mandate, but actually they're already doing that as much as the law allows them to do it.
Right. So the point here is we try to push car companies and I guess car buyers faster than they otherwise would like to go. Right. The point is that they're struggling to meet the mandate. That's the important context here.
Yeah.
Okay.
Yes, they're not voluntarily overshooting it. If we took the mandate away, there would be a smaller share of electric vehicles being sold. So the mandate is what is supporting that higher share. And therefore, when you're thinking about how the tax interacts with it, you think of the mandate as fixing the share, and then what can adjust. If the share can't adjust, what can adjust? The overall demand for cars can adjust, so you can sell more or fewer cars. Or, conditionally on saying the price of the cars can change, but you can't sell more petrol cars relative to EV cars.
So try and put this differently then. So presume actually one last thing before I do. If you miss this mandate, you get a big stonking fine.
Yes.
Right.
And we could reach a point where electric cars look so unattractive relative to petrol and diesel cars that rather than making the electric cars cheaper and the petrol and diesel cars even more expensive, a manufacturer just decides, no, I'm going to
take the hit.
Sell more petrol and diesel cars and just pay a fine.
Okay.
We haven't reached that point yet.
Let's move on to another measure, shall we? Let's pick up on salary sacrifice, which we did touch a little bit on last week, but it's probably important enough that it gets another mention. So there's a reminder, salary sacrifice, at the moment you can make pension contributions by sacrificing some out of your salary with your employer, and they then make some employer pension contributions. At the moment, those contributions are entirely free of national insurance, either employee or employer national insurance. But after the budget from which year, Stuart? 2027-8? They're going to be
No, 2029, 30.
Or even later. So from 2029-30, there'll be a £2,000 per year cap on how many contributions you can make in this format and get the tax breaks on. So that is what it is. Behavioural responses, Stuart. How are people going to respond?
Well, so one thing is that they might just put less into pensions because it's not as tax favoured after 2029 as it is before 2029. They might also, of course, try and put more in before 2029 to get in there before the policy change kicks in. There's another possibility, which is at the moment, salary sacrifice means that individual employees and their employers make an agreement that they will sacrifice a certain amount of salary in return for a higher pension contribution. Now, if that can't be done anymore at an individual employee level, case by case, it may be that what we see is that employers start offering higher employer pension contributions, which still get this favourable national insurance treatment, and therefore lower salaries, as just a general proposition for all of their employees. You can imagine, hypothetically, a company that at the moment offers salary sacrifice scheme and half of its employees take it up and half don't. Well, it could just stop doing this salary sacrifice and employees might put money into the pension themselves or might not bother because it's not as tax favoured. Or they could jump the other way and say, well, okay, we'll do this across the board so that, in effect, all our employees are doing what half of them were choosing to do before.
And it's worth underlining that in that world, that would mean less control for the employees. Because at the moment, not all employers get access to these schemes. Some of them can only make employee contributions, and those contributions are already subject to national insurance. So some people are already not benefiting from this system. But for those who are, if the employer just decides to increase employer contributions in place of salary across the board, then you have less control. And even the people who want to make those contributions won't necessarily want to make them at all points in time. You might want to make higher contributions at some points in time and lower contributions when you're about to buy a house, for example. So if employers move in that direction, it might preserve savings, but at the expense of less control for individuals picking how much to save.
Yeah, and it's not clear why we would want the tax system to do that. What this reform does is that it removes an anomaly in one part of the system. So it's not clear why at the moment, if I as an employee want to make a pension contribution, I get more favourable treatment if I can do it this convoluted way through a salary sacrifice arrangement with my employer than if I just put the money into a pension myself. So you can see the sense in saying, well, let's not quite get rid of that advantage above £2,000 a year of contributions. But in doing that, it's introducing an anomaly on the other side of the equation, which is it'll mean that if my employer makes a pension contribution for all employees, pays lower salaries and higher pension contributions, then that's tax favoured. But if I get a higher pension contribution as a choice that my employer and I make on an individual basis, that's taxed more heavily. And it's not clear why we would want to favour essentially salary sacrifice done across the board for all employees as part of the scheme rules over employer pension contributions made via a salary sacrifice arrangement. So you're kind of helping with one anomaly but creating a new anomaly instead. And that's because the fundamental problem here is that we've got more generous treatment of employer pension contributions than employee pension contributions. And salary sacrifice is sort of halfway in between the two. And so you can either treat it like an employee contribution or an employer contribution, but it's then going to look strange compared with the other one. And what the government didn't fundamentally tackle is the broader question of, well, why do we want to have more generous treatment of employer pension contributions than employee pension contributions in the first place? And we don't.
And the answer is we don't, really. We could get into a big turn this into an episode all about the taxation of pensions, and we've written lots about this, but it's actually very hard to justify that different treatment. And all the time you have the different treatment, you're going to have some weird halfway house in the middle if you have something like salary sacrifice. So salary sacrifice was one change to the taxation of savings, but there were some others too, including a 2 percentage point increase in the taxes on capital income, so in particular on dividends, interest income and property income. I've bashed those before, Stuart. You ever go at bashing them? Or at least setting out the pros and cons?
Yeah, I was going to say, I think there are pros and cons the way they've done it. So the government rightly highlights that at the moment, income from savings and investment is taxed at lower rates than income from employment, and this will bring those two things closer together. And bringing those closer together feels like, broadly a good thing. Of course, it's a tax increase. You can bring them together by reducing the taxes on employment. So we're not arguing that the tax on saving and investment should go up any more than the tax on employment should go down, but there is a logic to bringing them closer together. The trouble is that the tax base, the definition
go.
The definition of what it is that we tax. And at the moment, increasing taxes on savings, dividends, property income just discourages saving and investment. And it discourages it in some particularly odd ways. And it discourages it more than necessary. And by doing things we discussed on earlier podcasts to do with giving proper allowances for the amount saved and invested, giving deductions for the amount people put away, doing away with some weird and horrible features like the way that mortgage interest relief is treated for landlords and things like that. You could have raised taxes on these sources of income doing much less damage than the way they're actually doing it.
So Ben and I have joked that if there was a Helen action figure and you pressed the little button on the Helen action figure, it would say both devil's in the detail and it's all about the base, which is true. And I realise it's like a broken record, but this is a great example of that, where the base really does matter because what you're taxing makes a big difference and the details matter. So the Chancellor has basically done this in a way that entails a trade-off. So some problems have got worse, some problems got better, but in savings incentives have come down as a result. Not in a way that's going to be huge and crash the economy, but actually in a way that had the Chancellor been bolder, she didn't need to have that trade-off. She could have had her cake and eaten it. She could have improved investment incentives and raised some revenue.
Yeah, and actually, even it's not just about rates versus base here, because I said in terms of the tax rates, it's bringing the tax rates on these forms of income closer to those on employment income. But in some cases, it's moving it further away from other things. And one that particularly stands out here is the taxation of property income, means that the taxation of rental property becomes even more heavy. Rental property becomes even more heavily taxed relative to owner-occupied property. And so you're increasing the bias towards owner-occupation rather than the rental market, which you can make a case for whether we should be encouraging owner-occupation rather than renting. We already do it to a huge degree. This is doing it even more.
Can I ask a question about what property income means? Is this like individuals getting rental income? So presumably does this also make it, if you're a company with a big property portfolio, does this mean that their tax hasn't changed, but an individual landlord is being more heavily taxed?
So the increased tax on property income is on individual landlords' rental income. A company that's renting out property doesn't pay that. It pays corporation tax on its profits, not income tax. But of course, the dividends that property company pays out to its shareholders are subject to this additional 2p tax, at least at the basic and higher rates, not the additional rates for dividends, unlike savings and property income. Getting back into the weeds of it. So it does affect property that is being rented out through a company, but in a slightly different way.
Okay. I don't feel too bad then for my shell company that lets me my flat.
Yeah.
It's still getting hit.
But we should also remember that it's not necessarily just the landlord, whether that's an individual or company, that gets hit by this, because what we're likely to see is that they're going to try and pass on some of this to tenants in the form of higher rents. So it can be the tenants as well as the landlords that lose out from this, and I would expect that to happen to a significant degree, and some landlords are going to want to leave the market altogether, given that given the increasingly penal tax treatment of landlords. And so if there are fewer properties available to rent going around, then that's going to, bid up the rents for those properties that are out there. So we shouldn't just think of this as taxes on landlords and investors. It can fall on other people, and tenants, renters are one of those groups.
So let's keep moving apace through the different measures so we get to do a few more. Cash ISAs. So the Chancellor has reduced the amount that you can shove into a cash ISA now from 20 down to £12,000.
If you're not a pensioner.
If you're not a pensioner. So pensioners carry on being able to shove their £20,000 in. All under the guise of saying they want to encourage more of an investment culture and get people putting the money into stocks and shares. In fact, I think this might have been a question we've used in the past for our juniors. So will the change in cash ISAs get more people putting money into stocks and shares ISAs, Stuart?
Yes, but that won't be the only effect and may not be the biggest effect. So some people, if there's a limit on how much they can save in a cash ISA, and they were lucky enough to be able to save that amount in a cash ISA, will now put it into a stocks and shares ISA instead. But some people might just decide to scrap ISAs and put it into a bank account, particularly, if they just wanted to save in cash, they don't like the idea of investing in stocks and shares. Some people might just save less as a result and not put it into something else, just do less saving and spend it today or give it away or whatever instead. What the balance is between those different effects, I think, is an open question. Also, whether and how far, the government should be pushing people towards investing more in shares and keeping less money in cash is, I think, an open question. I know our starting point as economists would normally be, well, let people put their money, wherever they prefer, and, they can make the choice for themselves. There are arguments that we should be kind of nudging people in one direction or another. How far you buy those arguments and whether this is a sensible way to do it, I think maybe a longer discussion for another day.
I mean, you might think there's a problem around an information failure where people don't have the information they need to make choices. That with better information, they'd make better choices for their financial investments. But in that case, you could also do things to give people better information about how to invest in stocks and shares ISAs, how to navigate that rather than capping their cash ISA savings.
What do we think the argument is for limiting it just to working age people who face a reduction? We think it's acceptable for pensioners to saving cash because they might not be around long enough to benefit from the stock market. I assume that's it.
I think basically that. I think it's that, if you're older, I mean, if you think in general for savings, usually the advice, this is not financial advice, but usually the advice when you're younger is to put things into higher yielding, slightly riskier assets because you've got longer for that to pay off. Once you're getting to the end of your life and you're sort of running down your savings, keeping them in safer, less risky assets is a better part of the portfolio. So I guess the argument is that for the older people, you're less worried about them having greater cash assets, whereas for young people, you're not.
I do wonder what's to stop you just getting a stocks and shares ISA and buying cash, which is a thing you can do. Presumably this creates a compliance issue for providers. I also think I saw something about they want to... If you want to, I've looked into this because this one actually affects me as well.
We're not handing out financial advice.
No, it's not financial advice. But if you want to, if you got even you're young and you've read you listened to your podcast and you've done your research and you decide to invest in stocks and shares, if you then want to take money out of your stocks and shares ISA, because for example you want to buy a house, the government will not let you now put that into a cash ISA.
Yeah.
So that's quite punitive.
Yeah.
If you're trying to hold on to your deposit before buying a house, but not financial advice.
I think it's basically to Stuart's point about, if you're going to restrict people's choices or manipulate their choices in somehow, you need a good reason to do it. And it comes with cost because some people will be young and will be perfectly reasonably holding cash ISAs because they're waiting to buy a house or something. They don't want to be putting it in the markets. And therefore, the minute you affect choices, it's not all going to be upside. It's going to be, some people will be worse off having their choices manipulated.
My view is I think this is broadly a move in the wrong direction. I think my view is that people should be able to save in cash pretty much however much they like tax-free. And so making the cash ISA restriction tighter, I think is a move in the wrong direction. We should also not overstate how radical it is. I mean, so for one thing, I'm old enough to remember that when ISAs were originally introduced, there were separate cash ISAs and stocks and shares ISAs. And actually, it's not that long ago that we had a situation where only half of your ISA allowance could be invested in cash. So this is actually moving us back towards where we used to be.
It was a big faff.
And it's not even moving us all the way back to where we used to be. So
It's also true the ISA allowance increased quite a lot in the 2010s, I want to say, right? So it's just probably like undoing some of that previous increase.
Okay, so let's move on. That's cash ISAs. There's a whole bunch of other stuff, Stuart, under the theme of entrepreneurship. And this is one where acronyms are, there's just lots of them. EOTs, VCTs, EISs, EMIs. Basically, there are a whole bunch of schemes that give tax breaks or advantages to either owners or employees of companies that are growth companies in some definition. And the government has changed some of that. So we're not going to go into all the details and weeds here. And we should probably say that actually, big picture, a lot of the changes here are small beer in terms of revenue numbers. But for some of the individuals affected, they could be, material. So let's work through at a high level. What are these schemes? And very broadly, what's the government doing and trying to do?
Yeah, so the two biggest changes in revenue terms are to what's known as employee ownership trusts and enterprise management incentives. Love the acronyms EOTs and EMIs. And so the government is getting £1 billion from changing the treatment of employee ownership trusts. Employee ownership trusts are where I've been running a company and I can basically sell the shares in that company to a new trust where the company will be run for the benefit of its employees. So it's a way to get to employee share ownership that the government introduced 10 to 15 years ago. But it gives big tax advantages for transferring companies to employee ownership trusts like this. And the biggest tax advantage is that any capital gain that I, the business owner, made on the shares before it gets transferred over, at the moment gets written off completely. So I've built up a business, I've made a big capital gain because the business is worth a lot more than it was when I started it or acquired it or whatever. Normally you'd pay capital gains tax on that rise in value, but if rather than selling it to a third party, I sell it to one of these employee ownership trusts, I escape that capital gains tax completely. Now, I think there is a question as to whether we should be encouraging employee ownership in general. There are advantages of employee ownership as well as disadvantages, but again, my starting point would be to say, well, businesses and their employees can decide for themselves whether that's a commercially desirable arrangement. It's not obvious, if it's advantageous, they'll use it. It's not obvious that the government should be stepping in to encourage it. You might be able to make arguments for that, but I've never understood why even if you want to encourage employee ownership, why that encouragement should be related to the rise in value of the business before it got transferred to ownership, or for that matter, the tax band that the owner is in, and therefore how big the capital gains tax saving is. So it seems like it's not obvious to me that the government should be subsidising it as it is, but it certainly don't think it should be subsidising it in this way. So I'd have been delighted if the government got rid of that capital gains tax exemption completely. It hasn't gone that far. It's halved the capital gains tax exemption.
So there's an unjustified or poorly designed tax break to try to encourage employee ownership that has been pared back and raised the government £1 billion. And then let's do one more of the other horrible acronyms. Let's do the EMI.
Yeah, so the EMI is the second biggest one, and this one is a giveaway, £700 million a year. And this is a form of, again, it's to do with employee ownership, but this is just an employee share scheme. So companies can pay employees in share options, which is just the right to buy shares in the company in future at a pre-specified price. And if it pays its employees in share options through this particular scheme, there are a bunch of different tax advantages to that. For one thing, it's the main one is that there's no income tax or national insurance on that granting of stock options to the employees. And this can be worth thousands, typically tens of thousands of pounds to employees in the tax saving. Now, this is, if you want to encourage employee share ownership, again, it's not obvious to me that we should be that the government should be getting involved either way in that. If you want to encourage it, this isn't as silly a way of doing it as the capital gains tax exemption for EOTs is, but it's still not obvious to me why share options should be a tax privileged form of remunerating your employees. And so what the policy does here is essentially expand that to a wider range of firms than are currently eligible. So it can now be available for firms with up to 500 employees rather than just those up to 250 employees as it is at the moment, and firms with more assets and things like that. Just it was restricted to smallish businesses. It's now going to be available to slightly bigger businesses.
Yeah, they call it scale-ups as well as startups.
Yeah.
So it's part of a broader sort of trying to make the UK a better place to found and grow a company is how they'd sell it, right? And it's sort of, you can make use of these share options, which are particularly, I assume, common among quickly growing companies, for example.
Yeah, maybe companies that are short on cash flow and want to use stocks and shares rather than be able to pay their people up front. But I think for me, a theme is that you maybe can make a case some of this stuff. And you're right, Ben, the government will very much point towards wanting to be a better place to grow a business, and it'd be good if the UK were a better place to grow a business. Having seen these schemes over the years now, there are lots of them. They're all a little bit different. They change quite frequently in ways that even we can't quite keep up. We have to check every time we want to talk about them. What I'd love to see the government do actually is take a proper look at this whole ecosystem of incentives and think a bit about what is it you're trying to incentivise, why are you trying to incentivise it, what is the best way to do that, and then once you've answered those questions, think of a simpler, more stable set of schemes that would work, rather than have this mismatch of however many schemes there are that seem to change all the time. Should we do one more tax before we run out of time? What should we pick? Should we do tourist tax, which actually isn't a tax we have yet? But the government has said they're going to give mayors in England the powers to raise what they're calling a visitor levy on overnight accommodation, maybe allow others to do that too. I think it'll be popular in some parts. I think the mayors will like the idea they get a bit more control.
Though Ben Houchin, Mayor of Tees Valley, has said he will never use this tax. He said he's been given the power to increase it, but he refuses. Now, I'm from the Tees Valley, so I'm allowed to say this. It's not the number one tourist hotspot in the UK. I don't think it'll be enormous sums of revenue fog-on there, but that's because it's devolved, right? That's great. It means a devolved mayor can decide if he wants to use it or not. That's what devolution's about, I suppose.
Perhaps one thing worth saying, this doesn't exist yet, and it will be for mayors to decide if they want it and how much they want to raise from it. I think we should be expecting if somebody puts it into place, it will be relatively small sums of money. This isn't going to be the big tax that suddenly funds local education or special educational needs or bins or whatever. It might be politically attractive to some because it will fall on visitors and not local voters. And therefore, if you can tax visitors and get some money out of them, that might be popular. It will, if it gets introduced, be very concentrated, we'd expect. So, as you were saying, not all parts of the country are tourist hotspots. If you're in a big city with lots of tourists, you might be able to raise more than if you're somewhere where nobody really wants to go. So,
but if you're the Lake District and tourists flock there every year and clog up the roads or cause damage or leave litter or something, you can imagine there's tourism-related costs.
Yeah, absolutely. So you can see it raises some money, particularly in some places. You see why they might want it. So I think in some ways the takeaway is that you shouldn't be thinking of it as a solution to kind of broader issues of how you fund local government or how do we make sure local government services are great, but it could be an addition that would help some places that some places might want. The government haven't designed it yet. That will be really important to see what no one's designed it yet. Whoever's going to design it, it hasn't been designed yet. But when one of these things does get designed, if indeed it does, that will really matter. So I can immediately think of a bunch of issues. For example, you don't want to just apply it to hotels and not Airbnbs, or to some bits of the tourist sector and not others, because then you'll start skewing that. So the design will matter, but another fun tax that we might see. Okay, let's squeeze another one in. But let's do a quick fire one. Energy. government has cut the cost of energy, well, not by as much as they say they have potentially.
Well, I'd say more only for a short while. So as with cars, there were actually a bunch of different measures here, and we shouldn't get into the weeds of what each of them is. But the big thing it did to reduce energy bills was take one of the levies that's on bills, essentially to help fund renewable electricity generation, and say rather than that being paid for by the energy companies and therefore finding its way onto bills, 3/4 of that is going to be paid by the government instead, which should help to reduce bills, but that's only for a 3-year period. So that biggest measure that it introduced will only reduce bills for 3 years. For the longer term, there are actually a set of permanent measures. There's one thing that currently goes on bills to help pay for insulation programs and the like is being got rid of, but another thing, which is taxpayer subsidies for insulation and so on, is actually being made bigger. And there's a warm home discount. This is one that will increase levies on energy bills a bit to help pay for support for people with people on low incomes, essentially people on means-tested benefits. Oddly enough, those whose homes are expensive to heat already get support, and this will be providing support for those whose homes aren't currently expensive to heat. So there's a whole bunch of these measures. In terms of what the effect on bills is, there's a sizable reduction for the 3-year period where the biggest of these is in place. A much smaller reduction, we think only about £30 a year on a typical bill in the longer term. But again, one thing that this brings home is precisely that we've got a whole bunch of schemes. And again, we've mentioned 3 or 4 here, but there are half a dozen or more others. And there's not a lot of sense of rationalisation of what should these things look like overall. How should we be taxing energy? How should we be supporting renewable sector? And the way that we tax different forms of carbon emissions is radically inconsistent. So this will do nothing really to help businesses with the cost of their energy, for example, which is massively taxed, whereas households that produce carbon dioxide by burning gas is going to be barely affected by any of this. So this is another, to go back to the theme that you were raising earlier, Helen, where we would like to see a kind of slightly broader view as to what are you trying to do and what's the best way to achieve it, rather than having a whole bunch of little schemes and fiddling with them each a bit at a time.
Yep. So some cuts in energy bills in the short run, not as exciting in the long run, still a mess of a system, I think is the high level summary of that. Let's draw this to a close, shall we? We've followed quite a lot now in the various tax measures in the budget. And actually, there were even more tax measures we could have wallowed in. We didn't even get to gambling and smothers. I think if there's one bright spot among all of that, it is the new tax on electric vehicles. We've been saying for a long time at the IFS that the government needs to do something to get a tax on electric vehicles, and this is at least a step in that direction, although there are many other steps that would be even better to take, especially towards taxing congestion. More broadly, look down the list of measures we've discussed, whether that's taxes on savings or salary sacrifice and pension contributions or entrepreneurs. The kind of theme there is that these are big, chunky, important bits of the system that need to be looked at holistically, where the government could have done a job reforming them, and instead what they've done really is just some tweaks around the edges where we could argue about whether it's a bit better or a bit worse, but nothing there that looks like genuine reform, where reform is very much needed. But for now, let me say thank you to Stuart and Ben. We might take a break from talking about tax for a little while. But then we'll come back to it before too long, I'm sure. If you've enjoyed this episode, please do share it with your friends and others. And if you'd like to become a member and support this and other work, you can do so for as little as £10 a month. We look forward to seeing you next time. Thank you.